What's up guys, Jake here. In this video, let's go over the gift tax because I feel like this is something that some people worry about when in reality it's not really a thing. But let me put in the disclaimer that I am not a CPA and I am not an estate planner. The gift tax really only applies to decamillionaires, people with a net worth of over $10 million. If you know this is you, then hire a CPA and hire an estate planner to avoid these taxes. And what you need to know up front is you can gift as much as you want to a non-profit, a 501c3 in the tax code. There is no limitations on how much you can give to non-profits. However, there is a limitation how much you can claim as a tax deduction if you're trying to donate to charities in order to reduce your taxable amount. Where the gift tax comes in is when you're giving money directly to maybe family or friends. And what you need to know up front is there is an annual exclusion amount, and in 2021 it's currently $15,000. Every couple years this is raised by $1,000, so eventually it will become $16,000 a year. And what this means is that you, over the course of a calendar year, can gift to another individual up to $15,000 in cash or stuff of value without having to report it to the IRS. So as long as it's $15,000 or less, this is covered by the annual exclusion amount. There's no filing required, no documentation required by either you or the recipient. Now, because of this rule, you can kind of get creative in order to give people more money, and I'll give you an example. Let's say that you're married, you have a spouse, and together you have a daughter, and your daughter has married your son-in-law. You can give up to the exclusion amount person to person per person. So if dad wants to give $15,000 to daughter and $15,000 to son-in-law, he is now gifted $30,000 to this couple. And mom can repeat the process. Give $15,000 to the daughter, give $15,000 to the son-in-law. So combined, a couple can give another couple $60,000 in a calendar year. And remember, this is per calendar year or tax year. So if they were to gift $60,000 on December 30th, they could do it again on January 2nd, and within a 7-day period, gift over $120,000 without anyone having to document this or report this to the IRS. But let's say there is a large one-time transfer. Let's say mom and dad want to give $300,000 to their daughter so that she can purchase a home or maybe start a business. How exactly does this work? Well, the daughter, the person receiving the money, never has to pay taxes on that money. This money is always tax-free for the recipient. But what the parents have to do is they have to fill out a tax form for the amount that went over that annual exclusion amount of $15,000. It's a one-page tax form. It's the Form 709. And what they're going to have to document is the amount that went over $15,000. So $300,000 minus $15,000 is $285,000 over the exclusion amount. This is what the Form 709 looks like. However, this is not going to cause a taxable event. I think you could make it a taxable event, but definitely don't do that. The tax rate would be really high. The reason why is because the gifting limitations in the tax code are deeply related to the estate tax, the tax that people pay when they die. However, the lifetime exclusion amount for gifting is the same as what you can claim as an exclusion amount for the estate tax when you die. This is called the Unified Tax Credit, and every time you fill out a 709 for gifting above that $15,000, you're keeping a running total of how much you've gifted over your lifetime. And what you have to do is you have to, when you die, subtract that from the estate tax exemption. And this is pretty high, guys. In 2021, the exemption of your estate that is free from being taxed is up to $11.7 million. So let's just do an example here. So the tax-free inheritance amount when you die that you can give to your children or family and friends is $11.7 million. But if you had given $300,000 in a year to your daughter so she could buy a house, you have to subtract that $285,000 that you filled out on that form potentially years before you died. So subtract $285,000 from $11.7 million. Your estate tax exemption is lowered now to $11,415,000. So when gifting over that $15,000, this rule, this tax, really only applies to decamillionaires, people at risk of going above that 11.7 and then no longer getting the full exemption. However, with proper estate planning, you should be able to avoid this unless you're just ridiculously wealthy and you have no trusts or no way of sheltering your income past this 11.7 million mark. A follow-up question you might have is, what do I do if I receive a large gift from someone who's international? This is a large sum of money coming from someone who's not a U.S. resident or U.S. citizen into the United States. In this scenario, you do have to report this to the IRS. However, once again, this is not a taxable event. So if you have an uncle in Canada who's a Canadian citizen who wants to give you $10 million, you can do this, but in the IRS, when you file your taxes, you're going to have to report this event. This is for legal purposes in the event that this money was somehow illegally gained. Now, your uncle in Canada has to figure out Canadian tax law to see if that was a taxable event on their side. So it doesn't matter where the money is coming from internationally. It's up to that country how they want to deal with it for estate tax purposes. But for the recipient in the United States, you just have to declare that you received it and you should be good. You shouldn't owe any taxes. If you guys want to do some more research, I'll leave some helpful links down below in the description. In addition, if you know more than I do, leave a helpful comment, give those a thumbs up. Also, give this video a thumbs up. It really helps out the channel. I greatly appreciate it. Till the next video, take care.